Good afternoon, everybody. Thank you for joining us today for our workshop on bonding and insurance capacity building. I am joined here with Andrew Larson from Brown & Brown. We're excited to have him present on this topic. And with that, I'll hand it right over. Thanks so much, Andrew.
Thank you, Julia. So good afternoon, everybody. My name is Andrew Larson. I'm an account executive at the National Surety Practice of Brown & Brown. Just to give you a little information about me, I'm from Seattle, Washington. I've lived in the Seattle area most of my life and still here. I studied finance at Western Washington University, graduated in 2008. I've been working in surety since 2017 and received my associate in fidelity and surety bonding in 2021. That's a designation for surety professionals. I was fortunate enough to come aboard the Brown & Brown ship back in February of this year. Very excited to be here today to discuss surety with you all. We'll be going through this presentation over the next about 50 minutes, after which we will have a 30-minute Q&A period to go over any questions you have. I imagine there are a variety of participants here for which much of this material will be familiar, others that may be completely new. I'll do my best to make this as informative and accessible and painless as possible, and hopefully not bore anyone to tears. I also would like to introduce my teammates here. We have Stefan Engelhardt and Tim DeWolf. Stefan, Tim, did you guys want to just introduce yourselves and give a little information and background about you?
Yeah, appreciate it, Andrew. So Stefan Engelhardt. I've been with Brown & Brown and Surety for about a decade now. Originally worked as an electrical engineer, a test engineer over at Intel here in Portland. I'm originally from Florida, though. In Surety, mainly my focus is the sales leader, the national sales leader in Surety. I'm focusing on mergers and acquisitions, private equity or venture capital investment for any firm, construction firm or otherwise that's going through that. So if that's something that ever happens to you, be sure to let me know and I can assist you through that phase of your business. Tim?
Yeah, great. Thank you. Tim DeWolf. I'm an employee benefits consultant, also about 10 years experience. Love being here today. Thank you, Andrew. I actually have a background unique to government contracting. Once upon a time, I worked for a TPA that specialized in fringe accounting, government contracting. Not too many people know the intersection that is employee benefits consulting as it pertains to Davis-Bacon, Service Contract Act, prevailing wage and such. But anyways, my employee benefits practice, we're based out of Portland. We have a great team for small business all the way through middle market and large enterprise accounts. Essentially, we have a great team. And if anybody needs support to scale, as a government contract, you might have explosive growth if you capture a contract. If you want to make sure you're handling things from a compliance standpoint, my team can handle that, and happy to assist in both inside and outside the rails of all things publicly funded, federal, state, local municipalities and such. Also want to introduce who's not here, but just make a mention, Brown & Brown, we're a full service brokerage. We also do, in addition to surety and health benefits, which is so pivotal in the marketplace, we can handle all things commercial insurance, which is all your general liability, EPLI, all the gamut, including work comp. Ashton Smith is on our team here in Portland, is happy to be a great resource. So at the end of this, where I think our team here on the panel can handle most questions, at least tell you that we can find out who can answer it, and then we can leave our contact information if you want to connect and have further conversations. So thank you, Andrew. Appreciate it.
Great.
Glad to be here.
Thanks so much. Okay, so let's talk about bonding insurance and capacity building in general. So let's move. So here's our agenda for the presentation today. We'll do a brief overview of Brown & Brown and where we'll discuss who we are, who we serve, after which we'll talk about the basics of surety. And as we dive into the fascinating, not at all dry world of surety, we'll discuss the importance of working capital, work in progress schedules, CPA prepared statements. We'll also be looking at the Small Business Administration's Mentor Protégé program. Finally, I'll discuss the current surety market and the ins and outs of the broker relationship. And as I stated before, we'll have a Q&A portion for the last 30 minutes to go over any questions anyone might have. So Brown & Brown is an insurance broker that specializes in domestic and international markets. We work with property and casualty, risk management, consulting, employee benefits, personal lines, and surety, as well as various other services. We are in the top 1% of insurance brokerages in the world when it comes to size, revenue, number of employees, and offices. Our revenue last year was over 3.6 billion, just to see there on the slide. We have more than 15,000 employees spread out across the entire country in over 500 Brown & Brown offices. Brown & Brown has over 80 years experience providing superior service to our customers, spanning all industries and market segments. We're a publicly traded company, and our headquarters is currently based out of Daytona Beach, Florida. The Brown & Brown National Surety Practice, which Stefan Engelhardt and I are part of, has 30 teammates who work virtually around the nation. This virtual office model offers agility and provides our customers the best of what a large brokerage offers, with the speed and responsiveness and personalized attention of a smaller surety-only brokerage. Collectively, we have hundreds of years of dedicated surety experience and manage bond needs of national and international customers. We are a national group and have teammates working in every time zone in the US, but many of our team members, including account executives, account managers, Stefan and myself, are based out of the Northwest, and our headquarters there is in Portland. So as you can see, we work in virtually every line of business in the insurance industry, including examples such as aviation, executive liability, cyber risk, and captive management, just to name a few. Unfortunately, I work only in surety and surety only, so my knowledge in these areas is next to zero. Luckily, we have Tim here who works with employee benefits, who gives us a little bit more information. I think we covered some of these things in my when I got my license 7 years ago. But it's important to know that Brown & Brown has experts in all of these different lines of businesses. Today, you just have some from me and Stefan on the surety side and Tim on the employee benefits side. So who do we serve? Well, practically everyone. We work with international, national, and small and large clients. We can tailor our service to anyone's needs. We have the teams and experience to support our clients, whether they're large multinational corporations or small businesses just starting out. We're here to help our clients grow, whether that be through organic growth or through mergers and acquisitions. Our teams are definitely equipped to help you guys with the strategic path forward. So now that you've heard a little information about our team and our services, let's turn to the fun stuff and talk about surety and what is a surety bond. So a construction surety bond is a three-party agreement in which the surety company assures the obligee, typically a project owner. In this case, very often we're talking about like federal government that's requiring the bond, that the principal, generally the contractor or subcontractor, will perform a construction contract. Surety bonds in construction are referred to as a contract surety bond. Surety bonding is a careful, rigorous, and professional process in which a surety company pre-qualifies a contractor and then assures the project owners that, in the surety's opinion, the contractor is capable of performing the contract according to the terms and conditions. Also, that the contractor will pay certain laborers, subcontractors, and suppliers associated with the project. Again, in this three-party agreement, we have the principal, generally our contractor, who will be executing the work, the surety, which is generally an insurance company like Liberty Mutual, Travelers, just as examples, who pre-qualify the contractor and back them on the bond. And lastly, the obligee, who's the project owner, like a federal government, state government, city, or even private company. Again, the obligee is the one that will require the bond. You may be asking, where does the broker or a group like Brown & Brown fit in? We are facilitators that work on behalf of our clients, which would generally be the principal, to establish a partnership with a surety so that they can provide bonds to a project owner or the obligee, like the federal government. So surety bonds are required on most public works projects led by federal, state, or local agencies. They're not generally required on private projects. However, an increasing number of private owners and construction lenders are currently requiring surety bonds as well. Just to give you a little information about the industry in general and surety, surety has really been around for thousands of years. It's actually first referenced in Hammurabi's code of 2750 BCE. That's the former king of Babylon, modern day Iraq. The oldest surviving surety contract actually dates back to 670 BCE. So surety has been around basically since the dawn of time, but didn't really become a true insurance product or credit mechanism until the 19th century. And we saw that with the beginning of the HERD Act, which was passed in the United States in 1894 as a way to protect the federal government from a common problem at the time, which was contractor default. The government was constantly running into this issue of contractors going under, not completing projects as specified, or possibly just absconding with funds, which resulted in a massive amount of waste. So they decided to turn to surety bonds as a solution to protect taxpayers' money. The HERD Act works to protect a contractor from default and to protect some contractors from non-payment by contracts. The HERD Act was eventually supplanted by the Miller Act in 1935, which basically requires performance and payment bonds on projects in excess of $150,000 and payment protection for contracts between $30,000 and $150,000. Most states have similar legislation now known as Little Miller Acts, although the bond threshold varies from state to state. So from these different acts you see, from the Miller Act or the HERD Act, and these little Miller Acts at the state level, pretty much any bond you have or any contract you have at the federal level, state level, is going to require bonding. As we see the proliferation of bonds from these acts, we see cities, counties, municipalities also creating their own bond obligations. So today, if you're working on a public project, you'll most likely need to provide a bond to the project owner. So there are three basic types of contract surety bonds in construction. There are bid bonds, which assure that the contractor's bid was submitted in good faith, that the contractor intends to enter into the contract at the price bid, and the contractor will provide the required performance and payment bonds if they're awarded the project. There are performance bonds, which protect the owner from financial loss in the event that the contractor fails to perform the contract in accordance with its terms and conditions. Most performance bonds cover workmanship of the project for 1 year after completion. This is a built-in maintenance term that is given at no cost. For any maintenance period that goes beyond 1 year, a contractor would need to apply for a separate bond known as a maintenance or warranty bond, which we can see here on this slide on these lists. If this maintenance or warranty bond is needed, it generally is issued at a discounted premium if it's issued on a project that was previously bonded for performance. We also talk about payment bonds, which are sometimes called labor and material bond, which protects certain specified tiers of laborers, subcontractors, and material suppliers against non-payment by the contractor. Generally, these claimants may seek recovery directly from the surety company under the payment bond. It's important to remember when we're talking about performance and payment bonds, when they're required by a project owner or an obligee, that they're asking for one bond. The performance and payment bond are two halves of one bond, and they serve different purposes. The performance bond is meant to protect the project owner. In this case, generally what we're talking about is the federal government or state government, or perhaps a city or even a private company if they're requiring it. And a payment bond, which is meant to protect subcontractors and suppliers that are working on the project for the general contractor. But it's generally one bond with one premium charged. There are thousands of other bond types and bonds used in every industry imaginable, including commercial surety bonds, which you can see on this list here. Some of the examples are custom bonds, tax guarantee bonds, court bonds, subdivision bonds, just to name a few. For this presentation, we're going to focus just on contract surety bonds, such as bid bonds and performance and payment bonds, which I just mentioned. But there are many different types that can cover many different obligations. One simple example is a contractor's license bond, which is required by statute if you're working in Oregon or in Washington. Generally, contractor's license bonds for a small amount, such as $12,000 in the case of Washington. I think that might have actually been increased recently, but when I was issuing bonds previously, that's what it was. Or a $30,000 statutory public works bond for the state of Oregon. I imagine many of you here that are participating in this presentation have already acquired these necessary license bonds for your business. While the process of getting license bonds is usually fairly straightforward, you might involve a credit check and payment for the premium. Obtaining contract surety bonding is a little bit more involved and complex, and we're going to talk about what's all involved with that now. So obtaining surety bonds is more like obtaining bank credit than buying traditional insurance. The surety company and its financial resources stand behind the contractor to enable the contractor to enter an agreement or a contract with the owner. Yet, like other types of insurance, surety bonding is a risk transfer mechanism, is regulated by state insurance departments. Surety bonds are generally available to those who, in the surety's opinion, can perform the obligation being guaranteed. Contractors qualify for surety bonds through the surety's pre-qualification process. So if you look on this slide here, we show some of the primary differences and similarities between surety and traditional insurance. Both surety and traditional insurance are regulated by the state insurance departments, but as you can see, that's pretty much it for the similarities of the two. We see that surety involves a pre-qualification process to prevent loss. One of the biggest differences between surety and insurance is the way they're written. Insurance is written on the expectation of some loss. Insurance companies offer their services to thousands of clients who are paying premiums every month or every quarter or possibly annually. The premium is expected to cover any claims or losses in that period, as well as the insurance company's overhead and hopefully some profit margin. And that's just how insurance works. Surety, on the other hand, is written on a zero loss basis, which means that for every account and every bond request, the surety wants to have absolute confidence that no claim will result from it, hence the term surety. Of course, losses do happen, but just to give you an idea of how rare it is, I've personally worked on, I think, 1, maybe 2 claims in the last 7 years working in surety, which just kind of goes to show how efficient and thorough the underwriting process in the surety world is. But we'll talk a little bit more about that in just a little bit. As you can see from this slide here, we see surety is a 3-party agreement, whereas insurance is a 2-party agreement. In the surety world, coverage is project specific. Each contract surety bond covers a project or a single contract. Insurance is usually term specific and renewable. Bond forms are usually standardized or may be negotiated between the owner or perhaps the surety and the contractor. Policy forms for insurance vary by insurance company. The coverage of an insurance or of a surety bond is for 100% of the contract price. Insurance covers up to the policy limits, less the deductible. So another very important difference that we're going to look at between insurance and surety is that in the event that there is a claim on a bond, the surety is going to do everything they can to recoup that loss from the principal or the insured. Sureties in this line, in this industry, have the right to the contract balance and indemnity from a contractor in the event that there is a claim. With traditional insurance, the insurance company will not expect to be paid back for the cost of a claim, and they generally have no rights to the insured's assets. Surety works a little differently. When a principal or contractor obtains a surety program, they'll need to sign what is known as a general indemnity agreement with the surety. That agreement states that if a surety must respond to a claim from the obligee, the surety will be reimbursed by the principal for any cost incurred by that claim. As stated previously, bonds are mostly required by law. However, many private companies voluntarily require them from subcontractors and suppliers as a way to protect themselves from supply chain and subcontractor default risk. Buying insurance, as we can see here, is voluntarily a way of managing risk of loss for the insured. So once a contractor's file is completed for a client by the surety bond producer, it's submitted to a surety company for review. The surety underwriter may meet with the contractor, who should be prepared to discuss all aspects of the construction company's current operations and future plans. The surety company conducts a pre-qualification process to verify that, in its opinion, the contractor can perform the contract. While each surety company has its own underwriting standards and requirements, there are fundamentals common to all industries, all sureties for underwriting practices. So the surety is going to need some basic things, no matter who you're dealing with. First, they're going to need financial statements. Generally, a surety will want the last 3 years of year-end corporate financial statements and principal's most recent interim statements. So right now, when I'm working with a client, I generally will ask for my client's 2021, 2022, and 2023 year-end financials, along with their end-of-month statements from May or April of this year, whichever one they have available. Also, if available, the surety will generally want to see personal financial statements from the owner or owners of the company as well. CPA prepared statements are preferable, but in-house statements will be acceptable, especially for smaller contractors. They'll also want to get an explanation of the capacity to perform the contract. A surety will want to know if the principal or the contractor has the ability to execute this project that they're trying to get support for. To do that, the surety will want to know what projects the principal's previously worked on. They'll want to know the scope, size, geographical location of those projects. They'll want to know current backlog of the principal. and evaluate their work in progress schedule if available, which is another item we'll talk about shortly, another important item for the underwriting process for sureties. They'll want to know what equipment the principal or contractor has available, number of workers they have on staff, etc. When working on one specific project, surety will also want a cost breakdown. And they'll want to know how much of the breakdown goes to subcontractors, suppliers working with the principal or contractor. Surety will want to look into the organization and know who the key employees are. They generally request detailed resumes from principals. They like to see who the CEO is, who the CFO is, and project managers. They'll want to know how long the company's been in business. Do they have any affiliates or subsidiaries or perhaps a parent company? In essence, they'll want to know and understand every aspect of a principal's company. The surety will also request references from subcontractors and suppliers, possibly letters of recommendation from project owners, architects, or engineers. They'll also look at the principal's credit history, not just the company's credit, but also that of the owners. So other things they'll look into for pre-qualification will include documented banking relationships. They'll want to see evidence of a bank line of credit. Sureties generally look for unsecured lines of credit that can be used to meet short-term cash requirements. It's a very important part of their underwriting. They'll also want to evaluate a strategic business plan that the principal may have, which is to outline or to talk about the type of construction work that's being done, how a company obtains its jobs, the geographic area where they operate, growth objectives, and things of that nature. The surety will also want to see that the principal has a plan outlining how the business will continue in the event that the owners or key employees' death or disablement. This is known as a continuity plan. So as previously stated, this is a rigorous process that provides assurance to a project owner that the contractor runs a well-managed, profitable enterprise, deals fairly, and performs obligations as agreed. Even after issuing a bond, sureties may monitor a contractor's financial statements. They may request job status reports from the owner or architect, and they can even meet regularly with the contractor to discuss how the project's going. So there's a lot that goes into all of this. So now that we've discussed some basics of surety, let's look at some of the keys to obtaining a surety program. Here we're going to discuss working capital. We're going to discuss work in progress schedules and the importance of CPA prepared financial statements, as well as the importance of the others, working capital and work in progress statements. So when a surety looks at a contractor's financial statements, they focus on a couple of key indicators, possibly the most important of which is working capital. Working capital is the difference between a business's current assets and current liabilities. That is to say, in general, that's how sureties generally look at them. Every surety has their own way of evaluating working capital, and they discount certain items such as inventory or account receivables, but just for simplicity at this point, we'll just consider it working capital to be current assets minus current liabilities. Working capital helps to indicate whether a company has adequate cash flow to cover short-term debts and expenses. Sufficient working capital helps to maintain smooth operations. It can help to improve a company's earnings and profitability. So working capital is a key factor in determining a contractor's surety credit and capacity. When a surety provides bonding program to a contractor, they give them a single and aggregate bond program limit. For example, a principal may receive a program of $2 million over $4 million, which means that a principal has been pre-qualified for a single project up to $2 million with an aggregate bond program, including everything up to $4 million. In general, sureties want to see that a company's working capital is about 10% of their aggregate program. So if you have a backlog or a program of about $4 million, the sureties generally like to see working capital around $400,000. Of course, that's an optimistic number and not a hard floor for bonding. If a contractor's working capital is on the lower end of the spectrum, they can shore it up with a revolving bank line of credit. The line of credit ideally is never touched and will cost the contractor nothing. It's simply there as a backstop in the event there are some unforeseen costs or issues with collecting receivables. The bank line of credit should work more as a fail-safe to keep operations running during potential cash crunch. Sureties view a sufficient bank line of credit as a vital asset for their clients, and they're going to be much more comfortable in extending surety credit with one in place. So working capital is not the only important metric, nor is the balance sheet the only important financial statement that sureties will want to review. They'll also be looking at a contractor's work in progress schedule, or WIP, as it's commonly known as. The WIP is a fundamental financial document that offers an overview of the costs incurred, the revenues earned for a project during a specific period of time. In this example here, you can see that the WIP is evaluating projects based on estimated costs, costs incurred, percentage complete, estimated revenue, earned revenue, total billings, and the difference between the two are, i.e., over and under billings. The WIP serves to weave together two critical components in construction, which are financial data and project milestones. So why are work in progress schedules so important? Well, WIPs ensure financial accuracy, as they'll be connected directly to other financial statements, such as the balance sheet and income statement. They demonstrate efficient cost management control and billing accuracy, both of which are key factors for surety and qualifying a contractor for surety support. Not having an accurate and current work in progress schedule can make providing a surety bond program very challenging, especially if a principal is looking to work on larger projects, perhaps in the 7-figure range. So we've discussed a lot of important aspects of the surety's pre-qualification process, but one thing that will set a contractor apart from the pack is the engagement and retention of an outside CPA. Any contractor looking to grow their business should engage a CPA for an audit or a review. Sureties look far more favorably at companies that have third-party reviewed financial statements. CPA statements can increase a contractor's surety capacity and also reduce the cost of premium for their bond program. CPA prepared statements can be presented as an audit, a review, or a compilation. An audit is the most comprehensive and most expensive, followed by a review and then the compilation. Audits and reviews are considered acceptable for sureties. Compilations are generally comparable to in-house or financial statements, not given really the same consideration or the same weight to sureties as in a review or an audit. I'd say the grand majority of my clients generally have reviews rather than audits. So when we're talking about CPA statements, what's included in them? Well, CPA statements should include the following. They should have an accountant's opinion page, which discloses whether statements were prepared according to an audit, a review, or a compilation, as we just discussed. They include the balance sheet, which shows assets and liabilities and net worth of the company. This helps the surety assess working capital and the overall financial condition of the construction company. Should include the income statement, which measures how well the business is performed. Surety will assess gross profit on contracts, operating profit, net profit, before and after tax provisions. The statement of cash flow, which discloses the cash flow movements from either operating, investing, or financing activities. The accounts receivable and payable schedules. Schedules of work in progress, as we have discussed, and contracts completed, which will show the financial performance of each contract and provide insight into potential for future earnings from contracts in progress. We'll also include a schedule of general and administrative expenses, which reveals how well overhead expenses are controlled and managed. We'll have explanatory notes that the accountant may have included with the financial statement. And lastly, a management letter, which conveys the CPA's findings and recommendations by the contractor's business. It's important to note not all CPAs will provide management letters, so you may or may not have that. Again, cannot stress the importance of CPA provided financial statements enough when attempting to work on larger projects. I've had several clients in the last few weeks who've run into this problem. Many of my clients are looking to work on projects in the 7-figure range. They're experienced, they're hardworking clients that probably can complete the project of these size, but they're having trouble getting surety credit because at these levels, sureties just aren't as willing to support them without verification from CPA that the statements they're looking at are accurate. So while getting support without CPA prepared statements makes things a little bit more difficult, it's not impossible. There's other ways we can get support if you don't have it. But again, providing these statements is extremely important for any contractor that's looking to grow their business and trying to get contracts of any potential size. So as you can see, the pre-qualification process of bonding is extremely in-depth. Sureties will evaluate every aspect of your company. They'll look at your employees, your professional relationships, They're going to look at every aspect of your company to try to understand it, try to understand what work you're doing, and to try to get an idea of if you're capable of working on the projects that you're submitting your request for bonding on. So very, very in-depth. So we can see that there's a lot involved, but what are the benefits of bonding? Well, the primary benefits of bonding can be summarized by detailing what surety bonds provide. That is, first and foremost, financial security and contract assurance. Surety bonds are the most comprehensive risk management tool an obligee can require. Surety bonds assure the project owner that, in their opinion, a contractor is qualified to do a job. Should the unforeseen happen and the contractor defaults, the surety is there to respond and to make sure that nothing is lost, that the owner remains intact or remains whole. As I mentioned earlier, in the private sector, bonds are often not required. However, many private project owners require that a contractor be pre-qualified by a surety. So it's another benefit of getting the surety relationship in place for working in private work. We see a lot of private owners ask for pre-qualification letters, or what we often call in our industry good guy letters, for a surety on behalf of their clients. These letters generally reference the duration of the relationship between the contractor and the surety, and the program limits that the contractor can qualify for. This letter serves as a vital referral from a trusted third party. Often, many private project owners won't work with contractors that aren't able to obtain this type of letter. Once the client has a surety bond program in place, the surety can help their clients with their own bond requirements if necessary. They can help them add language to their own contracts that will require bonds from their subcontractors and their suppliers, which will help them protect themselves from the risks of default from subcontractors or supply chain risk. So surety bonds have other functions as well. They relieve the private project owners from the risk of financial loss arising from liens filed by unpaid subcontractors and suppliers, and they protect taxpayer dollars on public projects. For private project owners, the payment bond of of a bond, you have the 1/2 performance, 1/2 payment. The payment bond can stand in place of a potential lien on a private project owner's property. For public projects, liens are not available to begin with. Thus, the payment bond can serve as a recourse for subcontractors and suppliers who are having a payment dispute with their general contractor that has the bond with the federal government. In the absence of liens, the transition from construction financing to permanent financing is much smoother. If the contractor requests help, sureties may offer technical, managerial, or financial assistance to their principal or contractor. This may help the project owner or project move forward and significantly reduce the likelihood of default. Sureties will always work with their clients to mitigate loss as much as possible because it's in their interest to do so. Should a contractor default, the surety will respond to ensure project completion. So surety bonds have many functions, many benefits, but what are the costs of these products? So rates vary from company to company and also depend on the size and type of the project, as well as the contractor's bonding capacity. As a side note, commercial surety bonds often have higher rates, but for the purposes of today's presentation, we're just going to focus on the contract side. So there usually is no cost for a bid bond or for a pre-qualification letter. The performance bond premium generally falls between 0.5% to 2% of the contract price. There generally is no charge for the payment bond when it's purchased in conjunction with the performance bond. However, the cost is not of massive or particular importance to the principal, as we always advise our clients that when they're preparing their bid, that they should always add the cost of the bond as part of their overall cost. So if you're looking at a project for, say, $10 million and the premium on a bond is 1%, there'll be an additional $100,000 that should be added to your bid, so that the cost of the bond is passed over to the owner of the project, as it should be, because the bond is for their benefit. So the surety pre-qualification process is certainly very involved and thorough. The cost is low, and there are many benefits and functions associated with surety bonding. But it's important to remember that a surety bond can't be bought. It must be qualified for. And qualifying for larger projects can be very difficult for smaller or newer contractors. I see clients every day that want to go after a project that they don't quite qualify for, or they simply might not have the experience or credit to work on. And so when we're working with clients like this, how can they get around this issue? Well, one option would be to work with the Small Business Administration's Mentor Protégé program. So the SBA Mentor Protégé program originated in 2020 from a combination of the 8A Mentor Protégé program and the All Small Business Mentor Protégé program. The program was created to help firms owned and controlled by socially and economically disadvantaged individuals, including minority-owned businesses, veteran-owned businesses, women-owned businesses, or people with disabilities-owned businesses. The All Small Business program was created to help small businesses that didn't qualify for the 8A program. But since both projects had the same goal, and it was exactly the same, they just decided to merge them back in 2020. The program is designed to enhance the capabilities of protégé firms by requiring approved mentors, or the larger businesses, to provide business development assistance to protégé firms and to improve the protégé firm's ability to successfully compete for federal projects or federal contracts. Assistance may include technical and/or management assistance, financial assistance in the forms of equity investments and/or loans, trade education and/or assistance in performing private contracts with the government through joint venture arrangements. Can also include guidance on management systems, accounting, marketing, pretty much anything you could think of that a larger company might be able to offer to our protégé firms. So mentors are encouraged to provide assistance relating to the performance of contracts set aside or reserved for small businesses so that protégé firms may more fully develop their capabilities. Many federal projects are set aside for small businesses and are businesses that fall into the 8A category of socially or economically disadvantaged owned businesses. So a mentor protégé may joint venture as a small business for any government contract, subcontract, or sale, provided that the protégé qualifies on their own. So if a protégé for a firm is a veteran-owned business and they're looking to work on a veteran-owned or a set aside for a veteran-owned business, they can work with their JV, with their mentor on that project. They just need to qualify on their own. If we have a set-aside contract for a woman-owned business, as long as the protégé firm from the joint venture, the protégé and mentor is women-owned, they will also qualify with that joint venture. It's important to note the SBA must approve the mentor-protégé agreement before the two firms may submit an offer as a joint venture for a particular prime contract or subcontract. A mentor-protégé agreement may last up to 6 years from the date of the Small Business Administration's approval. If the initial mentor-protégé agreement is for less than 6 years, it may be extended by mutual agreement and notification to the SBA prior to its expiration. The mentor-protégé relationship must be maintained for at least 1 year after given SBA approval. Annual evaluations are also required by the SBA so they can assess how the relationship is working. Failure to complete an annual evaluation or provide the required information can result in termination of the mentor-protégé relationship. Protégé may have 2 mentors at the same time. It's another important key factor there, as long as those relationships don't conflict or compete with each other. However, a protégé can have no more than 2 mentors over the life of the business. So what are the benefits of this program, the mentor-protégé program? Well, protégés can strengthen their competitive position by creating a joint venture with the mentor, which allow protégés to go after projects they might not be able to qualify on their own. Perhaps the projects are larger than anything they've previously worked on, or they're not able to get the surety credit just on their own because of the lack of experience. Remember, bonding is almost always necessary on federal projects, and the ability to get bonds depends on qualifying for them. So having that mentor there to joint venture can help them to qualify. Often protégés will struggle to get surety support without the assistance of a mentor. Also, protégé can gain technical and developmental assistance from a mentor in a variety of ways. Ideally, the program is meant to help the protégé grow their business and enhance their value. Mentors benefit from the ability to work on set-aside projects that they normally would not be able to work on. They can also develop a more diversified supply chain and network of subcontractors, which can create opportunities for them for investment, possible future mergers and acquisitions on their side. So the program can be very beneficial for both parties. So who qualifies for the SBA Mentor Protégé program? Well, any small business that's organized for profit or as an agricultural cooperative can qualify as a protégé. You can determine if you qualify as a small business by checking the SBA's table of small business standards, which is mostly based on annual receipts or average number of employees. Mentors can qualify if they're organized as for-profit companies, if they have good character and are not on the federal list of debarred or suspended contractors, and also that they're able to impart value to the protégé firm and to help them to build on their capabilities. The SBA Mentor Protégé program is not meant simply to be a vehicle for larger companies or the mentors to be able to work on the set-aside projects. That's a big benefit, but the overall goal is for the mentor to provide assistance to a protégé that will contribute to their growth and their development. So how can you apply for the SBA Mentor Protégé program? Well, first, it's important to note that the program will not match protégés with mentors. It's not a matchmaking program. Companies that are interested in working together must apply together. The application must be submitted to the SBA website, listed here as certify.sba.gov. To apply on the SBA site, you must already have a profile in the system for award management. To create a profile, you just need to go to sam.gov, also shown here on this site, on this slide. Both the mentor and protégé must complete the SBA's online tutorial and execute a mentor-protégé agreement that will need to be evaluated and approved by the SBA. The application process for this time frame is generally 15-day screening and 90 days of processing. So as you can see, applying and getting approved for the SBA Mentor Protégé program can take a few months. So it's important to work on establishing this relationship and applying well in advance of any specific project you intend on working on. So now we've talked about the basics of surety, working capital, working progress schedules, the importance of the CPA, and the SBA Mentor Protégé program. I want to talk about the surety market and the broker relationship. So there are many agencies and sureties out in the market today, both large and small. Some are specialized and work within a specific industry or geographical territory. In general, you want to work with a broker and surety that know your local market, but also has a national presence. That way they know the key players where you operate and have contacts across the country in case your company has opportunities in other states or regions across the country. Our surety team, the Brown & Brown here, we're a national group. We're not tied to any one branch or office. This allows us to utilize resources from around the country and to create specialized account management teams for our customers. In most cases, surety agencies that handle risk and insurance programs will have their own local surety teams manage their customers' accounts, which results in them just working with that local surety rather than accessing the full national resources available. When you work with a surety broker, you want to make sure you're working with an expert team that works almost exclusively on bonding. As stated previously, there are many brokers out there. Many have some experience with surety, but you want to make sure that your broker you work with is surety first, not just a property and casualty broker that sometimes works in surety. As stated, there are many sureties with different specializations. Some are regional. Also, sureties have limits on what they can support based on government T listings. So it's important that your broker know and understand the surety markets, both large and small. You'll want to make sure that the broker you work with maintains active surety contracts with all major sureties, including regional and specialty markets. You want to make certain that the broker you work with has the experience and capabilities to handle all types of bonds in both contract and commercial surety. I've spoken almost entirely about contract bonds today, but commercial surety is an important aspect to understand. It can be very complex and certainly necessitates experience and expertise. For example, one industry on the commercial side we've seen come to the forefront in the surety world recently is renewable energy. This is a new industry for many in the surety world. Many brokers and sureties don't work in it simply because they don't understand it yet. It's just something they haven't gotten their heads around quite to this point. The Brown & Brown National Surety Practice currently has a team of 8 that work solely in this industry. We're actually an industry leader, and we pride ourselves on our knowledge and experience in it. There are many other examples that are very complex, frankly strange bond requirements that could be out there in the commercial surety space. Some of the strangest come from Florida, not surprising. One example would be one of the strangest ones I've ever heard of is an alligator nuisance bond. Hopefully not, you see Stefan nodding his head. None of you here will ever you'll never need to apply for that, I hope. But it just shows the necessity of having a broker that truly understands the complexity of both contract and commercial surety. Another thing to note that not all brokers and not all sureties are appointed with the SBA. So it's important to find a broker that can or is willing to work with the Small Business Administration, and make sure that you have a broker who has the knowledge and experience to work with the SBA and to help their clients grow and to have that assistance in that development. So when looking for a broker to partner with, you want to make sure they have some key characteristics. First, you want to make sure you have access to senior and specialist resources. The surety world's very relationship driven, and having a broker that has that reputation and has developed relationships can help you get the best bond program available, which will be vital to your future growth. Second, you want to make sure that a broker you work with has a committed and passionate team that will serve your needs. It's not uncommon for us to pick up a client simply because the broker they had previously had just wasn't as responsive as they should have been, didn't pick up the phone when the client called. Some brokers are more concerned about new business than existing business, and do themselves and their clients a disservice by neglecting them once they brought them in. So you want a broker that understands the importance of being responsive and working to build on existing relationships. Third, there's no substitute for experience. There are many agencies and brokers out there, and some are more experienced than others. With experience comes knowledge and these long-lasting relationships with sureties that can offer you bond programs generally under better terms and conditions and possibly with better rates. Anything you wanted to add here, Stefan?
No, you covered it quite well.
Oh, okay. Well, thank you. I appreciate that. So that is my presentation as so far regarding surety and bonding. Thanks everybody for listening. I hope that wasn't too dry or too drawn out. Julia, if you wanted to move forward there.
Yes, absolutely. Thank you so much, Andrew, for the wonderful presentation on bonding and insurance capacity building here. On behalf of Washington Apex Accelerator, thank you all for participating in our latest workshop. Please stay tuned for our next. Take care, everyone.